Welcome to Insights. I'm Eric. Thanks for stopping by today. We're going to do an S&P 500 review, and we're just going to address a question that was sent in to us about how the output of the matrix relates to this particular interpretation. Anything from this source is certainly well constructed and definitely will be taken on as something that is worthy of a challenge or even a look at. Other sources we're not going to do that with too much. Nobody really is out there doing their homework. But in terms of critical analysis, this is some stuff that's out there. We don't really dig into what other people have to say, but we'll certainly look at the output, and we'll look at the output relative to the matrix. The one advantage of the matrix is that you get to look at this stuff without having a computer make the interpretation or a computer generate the results for us. We get to do it ourselves. In terms of the S&P 500, the suggestion here is that the market will rally into a September cyclical high, and underlying it's somewhat weak. There's different types of language being used here. You can spend the time to read it and take a look at it, but it really identifies this 4,500 on the S&P 500 futures mark as an important technical trigger in order to generate further upside or continuation of markup. So we're going to take a look at that, and this is going to be a review that'll be a little bit longer than a normal one. We normally don't go into this detail. This is the kind of stuff we talk about in reports. This is what we talk about in the NASDAQ 100 report. We don't have an S&P 500 report ongoing. The NASDAQ 100 has different reversal markers. It's looking at the same energy build. We look at the composite equity DI, but we make different interpretations from the NASDAQ 100 rather than the S&P 500. So the S&P 500 is a mark. You can see it. We're at about 41.45 on the cash index or the spot index. And it's a market that's in misalignment, or it's in consolidation, because we have a daily up, a weekly down, and a monthly down. If we slide over here, you can see it all. That places the composite trend in consolidation against a primary downtrend flip. The flip is 4 months. It's produced a 0% return. It was profitable, but we've erased some of that for various reasons. We're going to talk about that as well. We're in the month of August, and the month of August is relatively a not particularly strong month through 1950, and this can go back quite a bit of time. It also is not particularly strong in September, and this talks about a turning point within September, and these are all possibilities. A September turning point can take place, but we're going to talk about how we can see that and at what level the matrix sees that. One of the reasons why we have rallied is the energy build, and that has been in place, is one of the strongest that the equity DI has produced in the last 20 some years. It's much stronger than all the previous ones. 59 and 51, and this is the WA calculation, and here's the standard volatility calculation, where the adaptive one, this is 60 and 48. These are pretty sizable energy builds from the standpoint of a build that would be considered bullish, and it's the size of these builds and how long it's been lasting. It's one of the reasons why the equity market has turned from a low here, and a reaction low, you can go look it up, whatever is right around that price, is due to this, mainly this energy build itself. Now, this energy build has only been able to turn the daily trend up so far. And we're going to take a look at the 3 time frames right now. The composite trend is a function of the daily, the weekly, and the monthly trend, and these are all here in graphical form. When they are shaded green, they're up, and we can see there's a green box in the daily, but we have an unshaded region in the weekly, and we have an unshaded region in the monthly, and that's problematic. It's one of the reasons why the market is out of gear, is a little bit disorganized, because it's only rallying in the 1 time frame. So I wouldn't get too excited about this. So I would agree, this is a market that is rallying based on a sizable energy build, but that energy build is not well defined inside the composite trend yet. We have only turned up the shortest term time frame. In terms of the weekly and the monthly, which are the longer term trends, who are far more influential than just the daily trend, there's a lot more work to be done. You can see the oscillators, and then you see the price oscillator, the volume oscillator here, the red or the blue trending line. They're still well below the dotted line or zero. It's going to take time to get above this or a sizable rally. In terms of time, and we've got some of the weekly counts here, the average weekly bear counts, and you can pull this off of the Lead W tab here. You can go look this up when you download your matrix, and you can find these boxes, and you can find the S&P 500. I don't want to spend too much time. I don't want to have something that goes on too long so it loses people's interest. What we are going to talk about here is the weekly time frame, and the weekly time frame is currently down. It averages across about 25 years, about 14 months on average. It can go high as 58. This particular count is 26 weeks, so we're above the normal cycle, and that's why the BSRT, which is the time cycle count, is 0.7. So this is a number, and you can look this up. This shows up right here. It's 0.7 and it's 26, and you can see all this stuff. None of them are shaded red yet, which means that the downtrend is not extended. They're still mostly negative. They're mostly black in color, and that's what keeps this cycle largely a weak one, even though the daily impulse is currently up. So as this turns up and these cycles they're playing within historical basis, the average historical count on the downside is 14, and it produces a 13% return. We're currently at 7. We've got as far as 20, so it's kind of met that average. Average max is 19%. We got max of 20. This can go a lot further down. I'm not sure I would compare this to 2008 and a protracted decline quite yet. But the weekly impulse has kind of done its minimum. If it wants to and can turn back higher, it could do so theoretically on the weekly time frame. The problem starts to align in the monthly, and this is what it's not that hard to draw this conclusion either. All this data here is captured from the Lead M tab, and you can see it here. You can pull it up yourself and pull these numbers up. And I'll head back here to this, and you can see the bear cycles and the bear counts. The average count is 9 months in duration. We're currently only at 4, which does target a decline or a struggling phase in the primary trend. The amount of time the average duration would take us until the market turns in 2023. So we are not exactly a bullish endorsement quite yet. This could take into the first quarter of 2023, and that's kind of what it's talking about right here into the computer generated output that we're looking at. That is supported here within the average cycles. I'm sure that computer is picking up the same type of information this computer is generating, which means this market has dropped. It's dropped below the zero line, and it's dropped pretty substantially. You can see short slivers tend to occur when the red line doesn't get really too far below the zero line. But this one dropped below minus 0.25. And when that happens, there's a much bigger broken box, so to speak, unshaded region than just a small sliver. So the idea that this one's going to end at 4 months is probably optimistic thinking. It's probably not likely to happen just because of the size and the severity of the sell-off. The fact that we dropped below minus 2.5 means there's a lot more work to be done, and that work's going to be generated to the upside. And you've got to get this number above the dotted line, and that's going to take time because the sell-off was so strong. Previous year's sell-offs that has also done that have pushed as low as minus 0.5. Some of them got below that, some of them approached that. You can see the boxes, the unshaded boxes are just much wider, which tends to think that this 4 count is just too short. Will likely hit a 9 count. You could go as high as 31. It's probably unlikely, but this is where the window doesn't start opening up for a bottom until the first quarter of 2023. And That's not what the bulls are saying. I don't think this is a market that's ready for a collapse and a crash. That comes in the next cycle, or the odds of that are much greater in the next cycle. But this is a market that it could struggle, even though the weekly count is it meets the minimum requirement. The monthly does not. And then when you combine that with the fact that we're seeing some decoupling here, this is expanded into the weekly decoupling just a few days ago. It's cut back a bit as the equity market has rallied, but these daily decouplings still exist. This is a market that's still out of gear. It could fall off, but if it keeps showing up, and it would show up again in September, this is a market that could easily get stopped in the time cycle of roughly September. Have another push down, either a push down to the retest of the lows or a push down through the lows is a possibility. We'll take a look at that in a second, but this is not a market that's in a great position. A market that would be in a better position would be a market that's up, up, and up with all three of them close to a breakout. But this is just a market that's just only pulling up the daily. Not to mention that in terms of the volatility, you can see that there's all sorts of cycles that take place in price and time. And volatility is one of them. And a market that's ready to turn has to be near a low or a compression state, which is a down arrow in COM. We don't see that in the name column here because volatility is still too high. It's still too high after the decline phase, and it needs to compress. The fact is it might compress as we push the weekly, and then the daily, weekly and daily would go up. Perhaps then we get more of a compression, but that doesn't mean the market's ready to jump the creek either, because it could be pushed up too far on the daily. It needs to come back down again. You need to get all three of these cycles in gear to the upside, and that's going to take time. Usually that takes a minimum of 2 months, even if it was a great setup from here and everything worked out, to as long as 6 months. And that's where I'm thinking this computer is picking up a turn in 2023. That's pretty feasible based on the cycle setup. Getting these three time frames aligned takes time. The other things that the matrix and the computer is picking up on is this market is being led by the Dow Industrials. This is on a weekly basis, and this is on a monthly basis, and the same conclusion. Dow Industrials is the leader here. The computer saying the Dow Industrials is the leader. This is an international big money market due to liquidity. This is not, the Dow Industrials does not tend to lead during rally phases. It can lead during bear markets and liquidity driven events, but it's not the leadership that we'd like to see. You'd like to see the NASDAQ 100 or preferably even the Russell 2000. And those groups are definitely lagging behind even the S&P 500. They're negative here, and even down in here they're negative, which means the S&P 500 is even more liquid than the what you call the high alpha groups. And that's problematic as well. That's what raises the eyebrow of concern even into this daily impulse up, that the liquidity is not right in terms of the flow of capital into the market. The fact is you still have decoupling too, and those are problematic as well. So in terms of the energy, you have a decent energy build, but this energy build could release off a little bit, and then it can come up and make another high as you get into 2023. This is the energy build that turns the market, but the market is not fully ready to be turned. What they also said, and this wording says right here, is that the market needs to close above 45.93. I can't vouch for that. I can see what our computer says. Here's the reversal tabs. We tend to follow the weekly and monthly. A big close above 3,200 was quite bullish. Right now, and I'm going to take a closer look at this in a separate tab, we're stuck within an air pocket between 4,000 or 4,021, we'll call it this band right here, and 4,500. It's from here to here. And so I would have to say, even though the other interpretation says you need a close above 45.90 something, this was about 45.14, and this is a minimum sized air pocket or minimum size reversal zone. It's probably bigger than that. So it does compare fairly well with that in itself. That's this red line right up here. If you want to get into a breakout where price is going to jump the creek, we're going to have to get above this 45.14 and 45.13 zone. It does mean that the market could easily rally between 4,000 and 4,500. But if you get up there and the energy starts to it starts to dissipate, and you get a lot of decoupling. This is a market that's also come back down and test of the 4,000 zone as well. It just is a market that's not ready. So in terms of how does this play out relative to what we're seeing here, I can see a very similar interpretation. You have to wait until the composite trend has to get into triple alignment. You got to flip that primary trend from down to up. It's going to take a minimum of 2 months and quite a bit of work. If we remember the composite trends here, and we're way down here. There's no way this can come back up in 2 months. This probably takes you 2 months just to get close to the dotted line and then flip it, especially if you have any type of setback like you do here, where it comes up and then it drops back down again. You can see numerous examples of it. It's going to take time. You need to get this a lot closer than that, and to get this BW, which is a measure of volatility, it's way above zero point 0.5. That needs to be way down below here before the trend is really close to cracking above the dotted line, which is 0, and that would mark a significant shift in the primary trend from currently down and unprofitable to actually being up. And that's something that's going to take time. I know the bulls don't probably want to hear any of that, but that's the real setup that we're talking about. I know there's some people trading different markets. We talk about in the NASDAQ 100 scalping against the primary trend because this energy build is so high, but that requires constant profit taking, and I'm not sure everybody who does this is that good at scalping. So the computer just says, say, stay away until the primary trend flips from down to up, and that itself is just not something that's going to take place probably at the end of this month. So this interpretation here looks fairly consistent with the output that we see in the matrix, and I hope by going over this, everybody who subscribes to the matrix here can do this relatively easy. And if you can't, in time you'll be able to see some of these things and see some of these setups for yourself, as well as watch these videos when we talk about it or I talk about it, and it's something that you can do on your own. The matrix is a constantly updated piece of information. We talk about this. It's updated on a daily basis, and the DIs and energy builds are updated on a weekly basis. So this is something that you can use as a form of information, and that adapts not only to the S&P 500, but the numerous other stock market groups and crypto, and you can see gold. And if you move any of this stuff, there's all sorts of things in here: Forex, grain market, bond market, agricultural, energy. These are all things that are part of the matrix, and that you can do the same type of analysis that we just did right now. If you have any comments or questions, let us know. If not, thanks for watching the S&P 500 review, and I hope this gives you a better understanding of what's taking place. It encourages you to use the matrix more than you already do, or dig into it for the first time. Thanks for watching, and we'll talk to you guys real soon.